Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor here at ETF.com.
This week, we're talking with Garrett Paolella, co-founder and managing partner at Neos Investments. Garrett, great to have you with us.
All right, Garrett, thanks a lot. We're going to kick it off here with a little bit of a big picture on Neos Investments. What exactly is that? Tell us a little bit about your business there.
Sure. So Neos Investments is a global asset manager. We utilize quantitative approaches to delivering yield enhanced and risk mitigated investment solutions. So our team actually has been some of the earliest pioneers in the option-based ETF category, going all the way back to around 2013. And for us, we've spent decades of years managing and developing different yield enhanced strategies, risk mitigated solutions across kind of those core building blocks of your portfolio. And for us, from an investment standpoint, it's really about data-driven quantitative approaches. So we like to utilize data as a means to give us, an expected outcome in the future, especially when we're looking at the options market.
How big is what do you guys have as far as assets and ETFs?
Sure. So we have 4 ETF products in the marketplace today. There's about 1.8, 1.9 billion in total assets in those ETFs. And then outside of that, we do sub-advise a couple of other funds. That gets us to about a total of 2.3 billion.
So, Garrett, I want to talk about your ETFs in a minute, but before we get into that, I want to kind of hear your take on the current macro outlook. And I want to start with the stock market, because obviously the S&P 500 started off very strong in 2024. Then we hit a little bit of a road bump in April with the 5 to 6% correction in the S&P. Now we're back up again, not quite at the record highs, but we're not far from them either. Do you expect more volatility, or is it smooth sailing from here?
Sure. So in our opinion, I think volatility is going to increase. Certainly not smooth sailing. And we really look at that as kind of that key driver right now is still inflation. And what is the Fed ultimately going to do to try to tamp down inflation and get to their kind of 2% target rate, which has certainly been a challenge. And so I feel like on a day-to-day basis, we're all living with, one piece of economic data coming out supporting, inflation's cooling a little bit, and the Fed's going to be able to, cut rates. The next week we're ultimately getting, numbers that are dismal and not what the Fed wants to see. So really, as we think about the stock market and where we've gotten to today, I think it's pretty impressive, even though you've seen quite an increase in rates and yields from where we were in January. If you think about it, in January, we came in off of obviously a pretty record run in the equity markets off the lows from October of 23. That's because the Fed was planning on cutting 6 times this year as early as March. Well, fast forward to where we were really about 2-3 weeks ago before last week's job number, and that came down to almost zero, right? 0 rate cuts, and actually people concerned about maybe a rate hike. So that's really been the key driver, is what is the Fed going to do? Where's inflation, and how is that reacting for the equity markets? As opposed to maybe equity markets leading, it's really now about the fixed income markets and what the Fed's going to do with inflation.
Have you been impressed or surprised, Garrett, by how strong the equity market has been? Like you said, expectations were 6 rate cuts heading into the year. Then they got, down to 0 to 1, and some people even talking about hikes potentially. Yet the S&P 500 only sold off 5% at the max, and, it's trading at 20 times earnings or something like that. Why is it so resilient?
So I'd say I was probably more surprised last month with maybe just a 5% correction. If you think about kind of that inverse nature of where rates and yields are relative to the equity markets, we saw rates basically up to 5% in the 10-year last October when the market was on the lows. As soon as we had a reversal of that and started to come down, the equity markets rallied really hard, really through basically about kind of 2 months ago. And so with rates coming all the way back from where they were at the start of this year to being at the level they are today, you would expect that the equity markets would try to be repricing in the fact of higher rates for longer. And so I'd say more recently I've been surprised. I mean, I think it made a lot of sense still in the beginning part of this year, but as we think about things now, it wouldn't be surprising to see another 5% correction, going back to retest the lows of April. But I think it's really, again, it's going to be it's I think investors looking at where is the Fed hopefully going to be. It's not exactly where they are today, but if we're looking at now maybe a potential, one or two cuts again, and they're trying to price in the fact that, we're getting jobs numbers like we did last week, and that inflation might be cooling. It's everyone's trying to take a crystal ball and take a guess at what the Fed's next move is, which is going to be challenging, and ultimately, in our opinion, just all will drive more market volatility, right? It's just the unknown for investors, I think, is what is constantly driving, sharper moves up or down within the markets.
So Garrett, you have ETFs tied to the S&P 500, but you also have one tied to the Nasdaq. And again, we're going to talk about those ETFs a little later in the show. But what's your view on tech and whether it can continue to outperform? Do you think that the Nasdaq is still the place to be, or has it become too risky?
So, in the short answer, here at a firm, we try not to take specific views. We like to provide our investment products to be solutions for investors to espouse their views, whether they like the Nasdaq exposure, they like the S&P, they actually don't like equities, they want fixed income or cash. So we try to give it an overall holistic opportunity for investors to choose, what we can do with option strategies over all of those core building blocks. But as I think about it, right, the Nasdaq was always known as this major growth, engine in allocation to more risky investments. As we've seen that kind of structural shift, if you think about a lot of those major tech companies, right, they've become much more insulated. They've become much more utilities. Google announcing its first ever dividend, right, because they're making a lot of money and they're not seeing just significant growth investments to be made. So I think the Nasdaq is a great place to be for long-term, allocations in the equity market, because if you think about it, whether now everyone's talking about AI being a big push, no matter what, any aspect or any industry out there that you're looking at, technology somehow, touches that, whether it's financial services or consumer, right? There's anywhere you look, technology is supporting that. And with the Nasdaq being such a tech-focused allocation, we just still see that as a long-term support to being invested in that space.
Let's get into fixed income a little bit here. I know you talked about it a minute ago, saying that the outlook is for, I guess, a rate cut or two still this year. But if we go back just 4 or 5 months ago, people were talking about 4 rate cuts this year. Who's getting it wrong at this point, and who's getting it right?
That's a good question. I don't know if anyone's getting it wrong or right, because I think it's so touch and go on a daily basis. Any type of economic data that's coming out suggesting maybe inflation's easing, right? It's an
Hmm.
instant shot to let's get long equities, and let's try to lock in rates and yields because there are going to be more cuts coming. And then, of course, the inverse, right? We get a second of data where it's not easing as much and everybody completely reverses the other way. So I
Hmm.
think it's challenging to choose, binary one or the other. I think it's really important for investors overall to still be building, right, good diversified portfolios across both, equities and fixed income. And until we really get a full signal, right, there's no reason in my opinion to jump all in on one way or the other, right? Until we really start to see rate cuts happening, are you going to miss that much of a move?
Hmm.
Or is there more risk by, taking a gamble that, one piece of economic data, is going to drive the Fed's, decision on significant policy shifts?
Specifically on the fixed income side, where do you think investors should be right now? Should they be adding duration in anticipation of what's coming from the Fed or from the market data?
Yeah, so I and we still feel like the short and the medium end of the curve is probably where to stay until you really start to see some meaningful policy shift. To get really
Hmm.
long duration right now, there's just going to be a lot of volatility in that and a lot of risk, relative to what your return potential could be. Treasuries are always great just simply because of the tax efficiency of them, right, and the liquidity. So, staying short in treasuries like in bills, but starting to ladder in duration in that kind of medium term, is
Hmm.
looking like a very great spot to be in. The reason I say that is what we love to look at here is really about tax efficient income, right? So a lot of what we do with our option strategies are thinking about what your net after tax yield is. If you think about fixed income, it's the same thing. What is the tax equivalent yield? Maybe not what is the overall gross yield you're going to get off, but when investors are looking about where to invest within fixed income, I think at this point is look at the tax equivalent yield. So, intermediate term munis are looking really attractive as one of the most highest tax equivalent yields. Just generally in fixed income, treasuries on the short end being at, north of 5% still with, almost no volatility and risk, associated with it. So I think for us, as we think about it, that short end and the medium, is probably where to stay until we get like an all clear signal that things are heading in, a long-term direction, to lock in for the longer term. But I always would suggest investors like look at your own individual tax situation and think about what is the tax equivalent yield if I'm going to be buying any type of fixed income.
Okay.
So Garrett, you have four ETFs on the market today, two equity funds and two fixed income funds. Let's talk about the stock funds first. You have SPYI and you have QQQI, and these are ETFs that provide exposure to the S&P 500 and NASDAQ while generating high income through option strategies. How do they work?
Sure. So both of those ETFs, SPYI and QQQI, fully replicate their underlying equity indexes. So we own all of the equities in each one of those respectively. And then on a monthly basis, we're really looking to institute via index options on that same. So let's use SPYI to pick one for an example. We replicate the full S&P 500 equity exposure, and then we use SPX, meaning S&P 500 index options, to generate a level of income for investors on a monthly basis. And the idea behind that is we really want to be driving tax efficient income. And so there's a variety of different ways without getting into all of them is we like to use tax efficient exposures, meaning those index options. Index options get a favorable tax treatment versus an ETF option or a swap or an equity linked note or some type of other synthetic. So we like to think about what is the most efficient underlying investments to be using for our investors. And then the overall thesis of SPYI in general is to give you exposure to the S&P 500, to give you exposure to the NASDAQ 100 that you already have in your portfolio today, but being able to deliver anywhere from maybe on SPYI 10 to 12% annualized yield off of it on a monthly basis, or on QQQI being able to go from 12 to 15%. So the idea really behind those is using the equity exposures as a means to give you a really high monthly tax efficient income that could complement that part of your portfolio that would be either equity dividend paying stocks, maybe REITs, maybe it's kind of MLPs or other equity like products that offer above average yield.
Garrett, I'm fascinated by these option strategies. They're all over the place right now in the ETF space. Calamos just came out with one that has 100% downside protection and I think a 9 point something percent cap on the performance. How does Neos differentiate itself from what's out there right now in the option strategies space?
Sure. So for us, it's been our entire career and focus is managing option-based strategies. So for us, coming to the experts that focus exclusively on offering just option-based products across all of your asset classes, is one way. The other way is we really think about tax efficiency. So for us, as we're developing a product, it's not just what is the total return or the gross yield that a strategy could deliver, but what is the net after tax that a client's going to take home. So if you think about the gross risk they're going to assume, what is the net return they're going to actually make off of it? So I think as we think about our products and delivering these types of solutions to investors, it's really thinking about the actual client at the end of the day of, if I invest in this, what risk am I going to take? What is the benefit of it? What's the net return I'm going to get even after I pay taxes? And you're right, there has been a plethora of products that everyone is just trying to throw out into the marketplace across the option space. We brought really what was the first ever option-based ETFs out in the market as a team under a different company, but back all the way in 2013. And so we've seen the whole evolution of the space. We've been some of the earliest pioneers in a lot of those different categories. of bringing different option strategies. And I think one thing is that definitely investors need to be doing their research, understanding, what it is that they're buying. But I think the way we really, as a key, separate ourselves is we exclusively focus on this, and it's really about what the client can get from a tax efficiency and a net after tax return.
Garrett, you also have two fixed income ETFs, a T-bill fund with the ticker CSHI and an aggregate bond ETF, BNDI. What makes these funds unique?
Sure. So what's unique about these funds are they are looking to enhance the income that you could get off those core underlying allocations of either T-bills or overall aggregate bond exposure. But the key is that we're not looking to really increase the risk or a lot of additional asset class volatility into it. So if you think about CSHI and being long kind of 1 to 3 month treasuries, we're taking a very conservative option overlay strategy to look to enhance the income by 1 to 1.5% per year. So that might not be a lot, but even currently on treasuries and T-bills earning around 5%, we can be upwards to 6.5%. If we do see rate cuts, happening over the next several years, right, that option income is going to be even that much more meaningful for investors. Same thing with BNDI. It's giving you exposure to the core bond market right now, which is yielding you maybe 3.25, 3.5%. BNDI for us is around just north of 5% on a total yield. And all that additional income that we're producing is on a very tax efficient basis for investors. But what's unique about it is if you just compared, say BNDI to ag or just your core bond exposure, you're going to see that the standard deviation, the risk is basically the exact same, but you're getting that extra 2 to 2.5% of tax efficient income above it. So it's really for people that want to still remain their exposures into either core bonds or risk adverse into like a cash money market short duration, but getting a nice increase of tax efficient income on top of that.
And let's wrap it up here with a little bit of a outlook for what you guys have coming up. And also, I'm curious as to how you I guess articulate these strategies to the marketplace. These are not garden variety ETFs that you're putting out there. I'm assuming you're reaching investors through financial advisors primarily, correct?
Yeah, so we do reach out to a lot of financial advisors. That's our core market. We do like to produce as much information that we can get retail approved to be on our website for educational purposes. We've spent our whole careers focusing on this and really pioneering, as I mentioned, kind of the option ETF category. So we like to keep things very simplistic. So we start with the benefits of the fund, and then, as the investor wants to, we'll peel back each layer of the onion as deep as they want to go, so that they could fully understand and articulate what it is to their clients. So for us, it's really about driving a lot of content, trying to keep things simple, but knowing that our team has an extremely deep, bench of capabilities to go as far as somebody wants to talk about options, derivatives, volatility, certainly the plethora of the other products in the marketplace and how they work with one another. So we really like to make sure that education is number one on the list for us in talking to clients and who we're reaching out to, regardless of what distribution channel that could be, if it's retail or into the financial advisor and intermediary space. And for us as a firm, we want to continue to just offer more solutions, right? We like investors to have the ability to choose what risk tolerance they want to take, what asset class they want to be in, what income or yield that they need to hit, that's going to get them this bogey above where inflation has now taken a bite out of their overall return in income, because things are just more expensive. So for us, continuing to launch products, that fill out the investors, asset allocation that can enhance yield, reduce risk, net after tax return, whether that be across the whole equity suite, fixed income, cash and treasuries, or other areas of their portfolio. We just like to allow the investor to choose what fits them, as opposed to thinking we could deliver, a specific product that might offer just one benefit. We want them to be able to, again, choose the risk and income profile that they need for their own portfolios.
Okay, and then anything on the drawing board you want to tell us about?
Nothing specific yet, but we do have several more products that will come out this year. So we'll be excited to be able to come back and talk more about that and work with ETF.com on some announcements there and articles and different things. But, so stay tuned on that. Definitely some future product coming out in the next 3 to 6 months.
All right. Well, make sure you get to us first on that. Okay, Garrett?
I will do.
Fantastic. Well, we're going to have to leave it there. Garrett, you gave us a ton of great insights. Thanks so much for your time.
Yeah, thanks for having me on today. It was a pleasure.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.